If you're within 15 years of retirement, stop scrolling. This video could be the most important financial decision you make this year, and it has nothing to do with your 401k. Most people your age are going to ignore Bitcoin completely, and for many of them, that will be exactly the right call. But for a few, it's going to be the most expensive mistake of their retirement. The difference between those two groups is what we're going to cover right now. This isn't about getting rich quick. It's about understanding a new type of asset and figuring out if it has a responsible place in your long-term financial security, especially when you feel like you did everything right, but still worry if it will be enough. Look, my goal here isn't to sell you on Bitcoin. Far from it. It's to give you the information you need to make your own informed decision. For those of us who are staring down retirement, our financial decisions just carry more weight. We don't have decades to recover from a big mistake. Protecting what we have becomes just as important as growing it. But first, here's the number that changes how we need to think about this. A 1% allocation to Bitcoin in a standard portfolio at the start of 2019 would have generated more profit by the end of 2024 than the entire 40% bond portion of that same portfolio. Let me say that again. 1% created more growth than 40%. To see how that's possible and to understand the risks, let's tell a tale of two investors. Let's call them Fiat Fred and Bitcoin Bill. Let's start with Fiat Fred. Fred is 50 years old. For the last 30 years, he's done everything you're supposed to do. He's maxed out his 401k, grabbing every last cent of his company's match. His portfolio is a textbook 60-40 split. 60% in a low-cost S&P 500 fund for growth, and 40% in bonds for stability. A classic, sensible strategy. For decades, this worked like a charm. He watched his nest egg grow steadily. He felt secure. But lately, Fred's been worried. He sees the news about inflation and feels it every time he fills up his car or buys groceries. That safe return on his bonds doesn't feel so safe when inflation is chewing away at his buying power. He's running into what experts call negative real yields, where his safe money is actually losing value. He remembers the lost decade in the 2000s when the stock market went absolutely nowhere for 10 years. He thinks, what if that happens again? I don't have another 30 years to just wait it out. Fred's a planner. He's banking on the 4% rule, the old guideline that says you can withdraw 4% of your portfolio each year without running out of money. But with today's low bond yields and stubborn inflation, he's starting to doubt if that rule even holds up anymore. He feels stuck, worried that the rules he followed to build his wealth are now boxing him in. This anxiety makes him shut down new ideas. He hears Bitcoin and immediately thinks scam or digital tulips. It's too new, too volatile, too risky. So he sticks his head in the sand and just hopes the old ways will be enough. Now, let's meet Bitcoin Bill. Same age, same job, same savings habits, same retirement goals. He's got the same 60-40 portfolio and shares every single one of Fred's anxieties. But Bill's reaction is a little different. He isn't looking to gamble his life savings, but he is open to at least exploring new ways to protect his wealth. Bill isn't a gambler. He's not chasing Lambos. He's a careful, disciplined saver who refuses to let fear make his financial decisions for him. He starts reading, and his journey follows the three big objections every person in his position has. His first thought is the one everyone has. This is just digital nonsense. What if it goes to zero? So he digs in, and he finds the one thing he didn't expect: scarcity. He learns there will only ever be 21 million Bitcoin, period. No government, committee, or CEO can ever create more. Suddenly, the digital gold comparison clicks. It's not about paying for coffee. It's a potential shield against inflation because you can't just make more of it. But the volatility still terrifies him. The price swings are insane. So he asks himself, how could I possibly put my retirement money through that? That's when he discovers the two ideas that change everything: allocation size and asymmetric upside. He does the math. If he allocates just 5%, A catastrophic 50% drop in Bitcoin's price would only be a 2.5% dip in his total portfolio, a manageable hit. But the upside? Because of that asymmetry, that small 5% could have an outsized, positive impact on his entire nest egg if things go well. And if you'd like to know where you stand with your retirement, or if you'd like to compare what Bitcoin looks like for you, head over to timtalksfinance.com, where you can use my retirement calculators absolutely free. There are plenty of retirement tools, and even some tools to save you money. His final hurdle is practical. This all sounds complicated and sketchy. How do I even buy it safely without getting scammed? He's relieved to find that the game has changed. With the launch of spot Bitcoin ETFs in the US and similar regulated products in other countries, he realizes he can get exposure right in his existing brokerage account, just like buying a stock. No weird websites, no digital wallets, no private keys to worry about. So Bill made his move. Not a bet the farm gamble, but a small, disciplined 5% allocation. But what happened next? Did that one small change actually make a difference for his retirement? And what became of Fred, who decided to ignore it completely? Okay, let's jump in our hypothetical time machine and fast forward 10 years. Fred and Bill are now 60, right on the cusp of retirement. How did things work out? Of course, this is just a story to illustrate a point. Past performance is no guarantee of future results, and the next 10 years will have their own unique surprises. Fiat Fred's 60/40 portfolio did okay. It grew, but modestly, barely keeping up with the rising cost of living. He looks at his final number and feels that same old anxiety. It's a good number, but it doesn't feel like the worry-free retirement he dreamed of. He's going to have to be careful, stick rigidly to that 4% withdrawal plan, and just hope for the best. Now, let's check in on Bitcoin Bill. His core 95% portfolio of stocks and bonds performed exactly the same as Fred's. That was the safe, reliable foundation. But that small 5% slice he allocated to Bitcoin, it made a world of difference. Over the decade, Bitcoin had its usual cycles of thrilling highs and terrifying lows. But because Bill was patient and held on, his small bet grew substantially. That 5% is now a much bigger piece of his net worth. The growth from that one small decision added a massive cushion to his retirement savings. Bill now has options. He can retire a little earlier. He can spend more on travel. He can face an unexpected health issue without it being a financial catastrophe. Most importantly, he has a sense of security that Fred just doesn't. His traditional portfolio is still the bedrock, but Bitcoin's performance bought him freedom and peace of mind. So, let's go back to the big question. Should someone your age even own Bitcoin? The answer isn't yes or no. It's maybe, but only if you do it the right way. It is absolutely not a lottery ticket to try and make up for a retirement shortfall. That is a recipe for disaster. But it can be a prudent strategic allocation for a small piece of your long-term portfolio. Think of it this way. For decades, retirement portfolios were built on two pillars: stocks for growth and bonds for stability. In today's changing financial world, it might be wise to consider adding a third, smaller pillar: a digital asset like Bitcoin for its scarcity and as a potential inflation hedge. It's not about replacing the old model, but augmenting it. The lesson from Bill's journey isn't a checklist, but a strategy. He didn't treat it like a lottery ticket. He treated it like a long-term strategic holding by making a small, responsible allocation using simple, regulated tools. He wasn't gambling. He was augmenting an already solid plan. For the generation that has played by the rules and saved diligently, the goal now is to protect that wealth for decades to come. Simply ignoring a new asset class that's being adopted by the world's largest financial institutions might not be the most conservative choice anymore. Perhaps the truly prudent path is to learn, understand, and consider making a small, calculated move.